In any given year right now, today somewhere in a glass tower in Manhattan, a brilliant analyst with a Harvard degree, 20 years of experience, a team of researchers, a proprietary trading algorithm, and access to more real-time market data than most governments have is trying to build a portfolio that beats a simple S&P 500 index fund. And statistically, with 93% certainty they will fail. Not over one bad year. Not during one crash cycle. Over 20 years of sustained effort, 93% of professional active fund managers have underperformed a basic, low-cost index fund that requires zero analysis, zero active decision-making, and sometimes charges literally 0% in fees. That number is not from a passive investing blogger. It is not from an index fund marketing campaign. It is from SPIVA S&P Dow Jones Indices, the official, globally recognized keeper of active versus passive performance data. And it has been confirmed every single year for the past 2.5 decades. This video is about what that number means. Not just for Wall Street professionals, but for every person who has ever bought a stock on a tip, traded a meme coin at midnight, held a speculative position through a crash, or wondered whether they should be doing something more sophisticated with their money than just owning an index fund. 7 chapters, 25 minutes, and a financial argument so airtight that by the time this video ends, you will never look at speculation the same way again. The $1 million bet. In 2007, Warren Buffett made a bet. Not a metaphorical bet. Not a philosophical argument. A real, documented, legally binding wager for $1 million. His bet was simple. A basic S&P 500 index fund, no manager, no strategy, no research team, no algorithm would outperform a hand-picked basket of the world's most sophisticated hedge funds over the next 10 years. One side of the bet, the index, passive, automatic, zero human involvement. The other side, 5 funds of funds managed by the most elite active investors on the planet. The hedge fund managers had every advantage. They had brilliant analysts. They had proprietary data. They had decades of market experience. They had every tool that modern financial science could provide. The index fund had none of those things. The index fund just owned the market. By year 9, the hedge funds were up 22%. The S&P 500 was up 85.4%. The hedge fund manager conceded before the decade was even over. The final score, S&P 500 Index Fund, 125% return. Hedge funds, 36% average return. The most sophisticated investment strategy money could buy, versus a product anyone can own for less than the price of a cup of coffee per year, and the index fund won by more than 3 to 1. That bet is not just a story. It is a proof, a controlled, real-world, decade-long experiment that produced one of the most important financial conclusions of the last century. And in this video, I am going to unpack every layer of what it means for your money. The FOMO trap. January 2021. A video game retailer on the verge of bankruptcy suddenly became the most talked about investment in the world. GameStop stock went from $2.57 to $480 in a matter of weeks. Social media exploded. Regular people, not professional investors, not hedge funds, just ordinary people sitting at their kitchen tables, were turning hundreds of dollars into tens of thousands of dollars in real time. You could watch it happening on Reddit, on Twitter, on TikTok. It felt like the biggest wealth transfer in history. It felt like the system was finally being beaten at its own game. And then it stopped. The median retail investor who bought in after January 25th, 2021, the exact point where the viral frenzy peaked, lost 13% of their investment. Not hedge funds, not Wall Street. Regular people who saw an opportunity, felt the FOMO, and acted on it. The same thing that made them buy at the top is the same force that has been redistributing wealth from retail speculators to patient investors for as long as financial markets have existed. That force has a name. It is called speculation. And in this video, I'm going to show you exactly what speculation is, exactly what costs you, and exactly why the single most boring financial product ever invented, the index fund, has been mathematically outperforming every alternative for decades. This is not a video about getting rich quick. This is a video about getting rich, and the difference between those two things is everything. Here is what you are going to walk away with today. Chapter 1 establishes the real, documented historical definition of speculation versus investing, because the line between them is where most financial decisions go wrong, and most people have never been taught exactly where that line sits. Chapter 2 is the SPIVA bombshell, the data that proves professional fund managers, with every conceivable resource and advantage, cannot consistently beat an index fund, and what that means for the rest of us. Chapter 3 is Warren Buffett's $1 million bet, the single most instructive real-world experiment in the history of active versus passive investing. Chapter 4 is the silent thief, the fee mathematics that show how even a modest difference in annual costs compounds into a catastrophic gap in wealth over time. Chapter 5 is the speculation graveyard, the documented human cost of FOMO-driven investing from meme stocks to crypto. Chapter 6 is the passive revolution, why $19 trillion doesn't lie. And Chapter 7 is the three forces, the framework that explains exactly why index funds are not just a good strategy, but a mathematically superior one. 7 chapters. Real data. Let's get to work. The SPIVA, the Great Wealth Divide. 2 investors, 2 outcomes, 1 decision. Before the 7 chapters, I want to draw a picture. Not a metaphorical picture, a mathematical one. 2 investors. Same starting capital. Same year. Same access to information. 1 is a speculator. 1 is an index investor. The speculator is intelligent, motivated, and doing everything conventional wisdom about active investing suggests. They research stocks. They follow earnings reports. They watch market trends. They adjust their portfolio based on economic indicators. They move to cash when the market looks dangerous. They chase sectors that are outperforming. They buy individual companies they believe in. They pay a financial advisor who charges 1% of their assets per year to manage their money. The index investor does almost nothing. They put their money in a low-cost S&P 500 index fund. They pay 0.03% in annual fees. They do not watch the news. They do not adjust their portfolio based on quarterly earnings. They do not move to cash when markets drop. They just own the index. Every month, automatically, without thought or emotion. 20 years later, who wins? The data is not ambiguous. The SPIVA scorecard, the most comprehensive, rigorously maintained performance comparison in the fund management industry, has been tracking this exact competition for 25 years. Over a 20-year period, the index investor outperforms the active speculator 93% of the time. Not sometimes. Not most years. 93% of the time over 2 decades. And that 93% figure includes professional fund managers, people with Bloomberg terminals, research teams, PhDs in quantitative finance, and billions of dollars in resources. If the professionals can't beat the index at that rate, what does that say about the retail investor trying to do it alone? With less information, less time, less capital, and more emotional exposure. Here is what the data says. It says that the most reliable predictor of investment underperformance is not market volatility, not economic cycles, not even bad stock picks. It is the act of trying to beat the market in the first place. The attempt itself is the problem. And Chapter 1 is where we understand why. 1. Investing versus speculation, the line that determines everything. Chapter 1. The line. In 1949, a man named Benjamin Graham wrote a book called The Intelligent Investor. Warren Buffett has called it the greatest book on investing ever written. Buffett read it when he was 19 years old and says it changed his financial life completely. And on the very first pages of that book, Graham drew a line, the most important line in all of personal finance, between investing and speculation. Here is his exact definition. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Read that again. An operation that promises safety of principal, your original money, and an adequate return. Everything else is speculative. That definition, written in 1949, explains almost every financial mistake people make in 2026. Because here is the truth about the financial decisions most people think of as investing that don't meet Graham's definition. Buying a meme stock because Reddit said it's going to the moon, speculative. Buying a cryptocurrency because someone on social media showed their gains, speculative. Buying an individual stock because you believe in the company's product, potentially speculative, unless backed by rigorous fundamental analysis. Paying a fund manager 1% per year to actively pick stocks, almost certainly speculative, given the 93% failure rate. And here's what genuinely meets Benjamin Graham's definition in today's market: a low-cost, diversified index fund. Specifically, an S&P 500 index fund. Here is why. First, safety of principal. The S&P 500 has never produced a negative return over any 20-year period in its history. Your principal, your original investment, has been mathematically protected over every 20-year window since the index's inception. Second, an adequate return. The S&P 500's average annual return over 100 years, with dividends reinvested, is 10.45%. At that rate, a consistent investor doubles their money roughly every 7 years. Third, thorough analysis. The S&P 500 index doesn't need your analysis because it automatically holds the 500 largest, most liquid, most profitable companies in the American economy, companies that have already survived the market's most brutal selection process. Speculation is the act of trying to do better than that. And the historical record is unambiguous about what happens when people try. Now here is a critical distinction that most financial media never makes. Speculation is not always irrational. In the right hands, with the right time horizon and the right psychological profile, a degree of speculative exposure can be part of a sophisticated strategy. But speculation is always higher risk, always higher cost, and always statistically less likely to outperform the index over the holding periods that actually determine whether you retire wealthy or broke. The index fund is not the exciting option. It is not the story you tell at dinner parties. It is not the thing that makes you feel like a sophisticated investor. It is just the thing that, based on 75 years of documented evidence since Graham wrote those words, wins. Chapter 2 is where I show you the most damning single-day data in the history of active management. And when you see the numbers not just for 1 year, but for 25 consecutive years, your relationship with the word outperform will never be the same. 2. The SPIVA bombshell: 25 years of proof that professionals can't beat the index. Chapter 2. The SPIVA bombshell. SPIVA stands for S&P Indices versus Active. It is maintained by S&P Global, the same organization that maintains the S&P 500 index itself, and it is the gold standard of active versus passive performance comparison. It tracks how professional active fund managers perform against their benchmark index across every major asset class, every time horizon, every year. And it has been doing so consistently since 2002. Here are the numbers, and I want you to really hear these, not just process them intellectually, but feel the weight of what they represent. In 2024, 65% of all active U.S. large-cap equity fund managers underperformed the S&P 500. That means nearly 2/3 of professional stock pickers people paid significant fees to do exactly one job failed to beat the baseline. In 2025, 79% of U.S. large-cap equity fund managers underperformed the S&P 500. It was the fourth worst year for active managers in the report's entire 25-year history. And here is what makes that number extraordinary: 2025 was supposed to be the year active managers finally had their moment. Market conditions in early 2025 included sharp volatility, tariff-driven corrections, significant sector dispersion, all the conditions that active management theory says create opportunities for skilled stock pickers to generate alpha. SPIVA's own research director said, and I quote, that the early part of 2025 provided an auspicious backdrop for active managers to shine. They still failed. That was also the 16th consecutive year in which the majority of active fund managers underperformed the index. 16 years in a row. But here is where it gets really stark. Let's look at the long-term numbers, the ones that matter for real wealth building. Over 3 years, 67% of active managers underperformed the S&P 500. Over 5 years, 89% underperformed. Over 15 years, 88% underperformed. Over 20 years, 93% underperformed. Fewer than 1 in 6 active managers beat the S&P 500 over 10 years. Fewer than 1 in 6. Now let me give you the context that makes this even more significant. The managers being measured by SPIVA have resources that no individual investor has. They have institutional-grade data. They have research teams. They have access to company management. They have quantitative models built by some of the brightest mathematical minds in the world. They have experience. They have time. And they are paid very well paid to do exactly one thing: generate returns that beat the market. And 93% of them, over a 20-year period, cannot do it. This is not a bad luck problem. This is not a temporary underperformance cycle. 25 years of consecutive data, covering bull markets and bear markets, covering the dot-com boom and bust, the 2008 financial crisis, COVID, the 2022 bear market, the AI bull run. Through all of it, the pattern is the same. The professionals fail to beat the index. Every year. Most of them, every time. The conclusion is not that fund managers are stupid. It is that the market is extraordinarily efficient, that prices already reflect available information with such speed and precision that consistently finding mispriced securities is functionally impossible over long time horizons. The index doesn't need to find the needle. It owns the entire haystack, and the haystack has historically grown at 10.45% per year for 100 years. But if you are still not convinced, if you think there's a chance that the right active manager with the right strategy can beat the index, Chapter 3 is the most concrete answer to that question ever produced. One man, $1 million, 10 years, and a result that settled the debate. 3. Warren Buffett's $1 million proof, the bet that changed everything. Chapter 3. The $1 million proof. In 2007, Warren Buffett, the most successful investor in recorded human history, the man who turned $100 into $130 billion through 6 decades of brilliant active investing, made a bet. And the bet was this. He wagered $1 million that a simple, low-cost S&P 500 index fund would outperform a basket of 5 hedge funds of funds over the subsequent 10 years. His side, the Vanguard Admiral Shares S&P 500 Index Fund. No manager, no strategy, no analysis, just the index. The other side, Protege Partners, a respected New York hedge fund run by Tom Seeds, selecting 5 funds of funds, which means 5 portfolios, each containing dozens of individual hedge funds, each managed by some of the most sophisticated active investors in the world. The bet began January 1, 2008. The very first year, 2008, was the worst financial crisis since the Great Depression. The S&P 500 lost 37% of its value. Buffett's index fund fell 37%. The hedge funds fell 23.9%. Round 1 to the hedge funds, the protection they advertised was real. Then something happened. The market recovered, and the hedge funds didn't keep up. By 2009, Buffett's index fund was ahead. By 2010, further ahead. By 2011, further ahead. The hedge funds never caught up. Not once from 2009 onward did the aggregate hedge fund portfolio outperform the index in a single year. At the 9-year checkpoint in 2017, CNBC reported the standing. Hedge funds up 22% on average. S&P 500 up 85.4%. That gap is not a rounding error. That is a fundamental structural difference in outcome. Tom Seeds conceded the bet before the decade was even finished. He didn't wait for the official conclusion. The evidence was overwhelming. The final score, S&P 500 Index Fund, 125% total return over 10 years. Hedge funds 36% average return. the world's most sophisticated active investment strategies, managed by elite professionals, charging substantial fees returned less than one-third of what a passive index fund produced. Now here's what I want you to understand about what Buffett's bet actually proved. He wasn't betting against the competence of the hedge fund managers. He wasn't saying they were incompetent. He was saying that the structure of active management, the fees, the friction, the transaction costs, the tax implications, the behavioral biases, the impossibility of consistently identifying mispriced securities in an efficient market creates a mathematical headwind so powerful that even elite talent cannot overcome it at scale over a decade. And if elite talent, with access to every advantage the financial system provides, produces 36% against the index of 125%, what is the average retail investor doing when they speculate? When they trade individual stocks on a hunch? When they follow social media tips? When they pay a financial advisor 1% per year to pick stocks that 93% of professional pickers can't beat anyway? They are not investing. They are donating. The market is not a game you win by being smarter than everyone else. It is a system you participate in most effectively by owning it entirely at the lowest possible cost for the longest possible time. The index fund is not the consolation prize. It is the prize. 4. The silent thief: how fees silently destroy speculative returns. Chapter 4. The silent thief. I want to talk about something that does not make headlines. Something that doesn't show up as a red number on your brokerage app. Something that never triggers a news alert or a social media post. But something that, over a 30-year investment horizon, will cost the average speculator more money than any individual market crash in history. It is called the expense ratio, and most people have no idea how much it matters. Here is the comparison. A Vanguard S&P 500 index fund, VOO, charges 0.03% per year in fees. A Fidelity S&P 500 index fund, FXA, IX, charges 0.02%. Fidelity's Zero Total Market Index Fund charges literally 0%. Nothing. Zero. The cost of owning the entire U.S. stock market in a single fund is, at best, nothing, and at worst, 3 cents per year on every $100 invested. Now let's look at the other side. The average actively managed mutual fund historically charges approximately 1% per year. Some hedge funds charge the traditional 2 and 2% of assets per year plus 20% of any profits. Financial advisors who manage portfolios actively typically charge 0.5% to 1% of assets annually on top of the fund fees themselves. 1% sounds small. It is not small. It is catastrophic in the compounding math. Here is the mathematical proof. You invest $100,000. The market returns 10% per year for 30 years. In the index fund at 0.03% fees, your $100,000 grows to approximately $1,744,000. In the actively managed fund at 1% fees, your $100,000 grows to approximately $1,327,000. Same market, same 30 years, same $100,000. The fee difference of less than 1% per year costs you over $417,000 in final wealth. $417,000. Gone. Not to market losses. Not to bad stock picks. To the annual fee. To the silent thief. And here is what makes this even more painful. John Bogle, the founder of Vanguard, the man who created the first publicly available index fund, and is arguably responsible for more ordinary people building real wealth than any other financial innovator in history, spent decades documenting what he called the cost matters hypothesis. His finding was simple. In investing, you get what you don't pay for. Every dollar that goes to fees is a dollar removed from your compounding return. And in a compounding system, every dollar you lose early costs you not $1 in final wealth. It costs you the compound growth of that dollar over your entire remaining investment horizon. Don't look for the needle in the haystack. Bogle said, just buy the haystack. For less than the cost of a Netflix subscription per year, often for literally nothing, you can own a fraction of every significant company in the American economy. Every Apple, every Microsoft, every Nvidia, every Amazon, every major bank, every major pharmaceutical company, every major consumer brand, all of them for free. Speculation doesn't just underperform because it produces lower returns. It underperforms because it produces lower returns and charges you more for the privilege of doing so. The fee drag is not the primary cost of speculation, but it is the most insidious, because unlike a market crash, it never stops. It runs every day, every quarter, every year, for decades, quietly, steadily, taking its cut. You are halfway through. Let me tell you what just happened. We defined the line between investing and speculation using Benjamin Graham's own 1949 definition. We saw 25 years of SPIVA data proving 93% of professional fund managers can't beat the index over 20 years. We watched Warren Buffett turn a 10-year, $1 million bet into the most important controlled experiment in investing history, 125% versus 36%. And we watched the fee math remove $417,000 from an otherwise identical portfolio. The next 3 chapters are where this gets personal. Chapter 5 is the speculation graveyard, meme stocks, crypto crashes, and the documented human cost of FOMO investing. Chapter 6 is the passive revolution, why the world's smartest institutional money has been moving to index funds for a decade. And Chapter 7 is the 3 forces, the framework that shows you exactly why index funds don't just win sometimes, they win structurally. If you haven't subscribed yet, hit subscribe right now. This channel exists to give you the financial framework that most people spend decades learning the expensive way. Let's finish this. 5. The speculation graveyard, meme stocks, crypto, and the real cost of FOMO. $16,000. Then, February 2026 crypto market down $2 trillion from its peak. Real people, real losses, real consequences. Chapter 5. The speculation graveyard. Everything we've covered so far has been about professional speculation, about how even the most sophisticated, best resourced active managers in the world fail to beat the index. Now, I want to talk about retail speculation, the kind that is marketed aggressively on social media, celebrated in the moments it works, and almost never honestly documented when it doesn't. Let's start with GameStop. January 2021. A coordinated retail buying campaign on Reddit turned a dying video game retailer into the most talked about stock in the world. GameStop went from $2.57 to $480. The stories were everywhere. People posting their gains. Ordinary people beating Wall Street at its own game. It felt like a revolution. Here is what happened next. The median retail investor who bought GameStop after January 25, 2021, the exact date when the story peaked and went fully viral, lost 13% of their investment. Not hedge funds. Not professional traders. Regular people who saw the number going up, felt the FOMO, and acted on it. The same FOMO that had made the stock go up was the same force that ensured most retail buyers got in at the top. This is not a criticism of the people who participated. It is a documentation of the structural reality of speculative manias. When a speculative asset goes viral, the majority of the gains have already been captured by whoever got in first. The retail investor who acts on the viral moment is almost always the last buyer, the one who provides the exit liquidity for the early holders. The FOMO trade is, by mathematical structure, the worst time to trade. Now let's talk about crypto, because it is the largest retail speculation experiment in human financial history, and the data is devastating. In November 2021, the global cryptocurrency market reached a peak capitalization of $4.379 trillion. That number represented real money from real people's savings, borrowed funds, retirement capital poured into a speculative asset class based primarily on the belief that prices would keep going higher. By June 2022, Bitcoin had fallen 63% from its peak. The crypto market had lost $1.63 trillion in market capitalization. Not paper losses, real wealth destruction for the millions of retail investors who bought near the top. And by February 2026, as this video is being produced, the crypto market has lost $2 trillion in value from its most recent peak. In a single recent crash event, more than $19 billion in positions were liquidated, $7 billion of them in less than 1 hour, wiping out over 1.6 million traders. 1.6 million people in 1 hour. I am not saying that every person who invested in cryptocurrency lost money. I am saying that the aggregate documented result of retail speculation in the most hyped, most marketed, most socially amplified speculative asset class in history is massive wealth destruction for the majority of participants. Not because the technology was necessarily bad, but because when the majority of investors are buying based on price momentum, social validation, and fear of missing out, rather than upon thorough analysis of intrinsic value, they are speculating by Benjamin Graham's definition. And speculation, statistically, has a loser for every winner. While the speculation graveyard was filling up, what was the S&P 500 index doing? In 2021, the year GameStop exploded and crypto reached its peak. The S&P 500 returned 26.9%. In 2022, the year crypto collapsed and meme stocks crashed, the S&P 500 fell 19.4%, a real and painful decline, but recovered entirely and reached new highs in 2023. In 2023, up 24.2%. In 2024, up 23.3%. The index doesn't go viral. It doesn't trend on social media. It doesn't make you feel like a genius, but it also doesn't liquidate 1.6 million traders in an hour. 6. The passive revolution, why $19 trillion can't be wrong. Chapter 6. The passive revolution. Here's a number that, in the context of everything we've discussed, tells you everything you need to know about where the world's sophisticated money is actually going. As of January 2026, globally managed passive investment assets total $19.1 trillion. Actively managed assets, $16.2 trillion. For the first time in the history of the fund management industry, passive investments index funds and ETFs hold more money than active funds. And the gap is widening every year. Globally, passively managed assets now account for 39% of all assets under management, and that number grew by 6.1% in a single year. Not 6.1% more dollars. 6.1 percentage points of total global AUM shifted to passive in 12 months. That is not a trend. That is a structural, accelerating reallocation of how the world's capital is managed. And here it is who is leading that shift. It is not uninformed retail investors stumbling into index funds by accident. It is institutional investors, pension funds, sovereign wealth funds, university endowments, insurance companies, the largest and most sophisticated pools of capital in the world who have reviewed the SPIVA data, run their own analyses, and concluded that passive index investing is the most rational framework for long-term wealth preservation and growth. The Norwegian Government Pension Fund, one of the largest sovereign wealth funds on Earth, allocates a significant portion of its assets to passive index strategies. The Yale Endowment, the California Public Employees Retirement System, major university endowments across the United States all have materially increased passive allocations over the last decade. These are not unsophisticated investors being taken advantage of by index fund marketing. These are the most analytically rigorous pools of capital on the planet, making deliberate, evidence-based decisions. Meanwhile, active management assets have been shrinking, not collapsing, but consistently declining as a share of total assets year after year. The money is moving. It has been moving for a decade. And it is moving in the same direction that SPIVA data, Buffett's bet, the fee mathematics, and 75 years of Benjamin Graham's intellectual framework all point toward broad, diversified, low-cost passive ownership of the market. John Bogle created the first publicly available index fund in 1976. The fund management establishment mocked it. They called it Bogle's folly. They said it was settling for mediocrity. They said no serious investor would accept average returns when they could pursue superior ones. Bogle said, and I want you to hear this, in investing, the average investor doesn't get average market returns. they get below average returns because of the cost of trying to get above average returns. 50 years later, $19.1 trillion in passive assets. The folly won. Chapter 7 is the most important intellectual framework in this entire video because it answers the one question that should be driving everything. Why? Why do index funds structurally win? Not just statistically, not just historically, but mechanically, mathematically, inevitably why? 3 forces. 7 minutes. The complete answer. 7. The 3 forces that make index funds mathematically unbeatable. Chapter 7. The 3 forces. Everything we've covered, the SPIVA data, Buffett's bet, the fee mathematics, the speculation graveyard, the passive revolution, all of it points to the same underlying mechanics. The reason index funds win is not luck. It is not a historical anomaly. It is the result of 3 structural forces that operate simultaneously and continuously, making passive index investing mathematically superior to active speculation over any sufficiently long time horizon. Force 1. The arithmetic of active management. This is the most elegant and least understood principle in all of investing. It was articulated by Nobel Prize-winning economist William Sharpe, and it is called the arithmetic of active management. Here is how it works. The total return of all investors in the stock market in aggregate must equal the market's total return. It cannot be otherwise. The market is the sum of all investor positions. So before costs, active investors as a group earn exactly the market return. Not more, not less, exactly the same. Now add costs. Active management costs more than passive management in fees, in transaction costs, in tax consequences from higher portfolio turnover. After costs, active investors as a group must earn less than the market return. Always, by exactly the amount of their costs. This is not a theory. It is arithmetic. Every dollar of outperformance captured by one active manager must come from the underperformance of another active investor. It is a zero-sum game before costs and a negative-sum game after costs. The average active investor cannot beat the index because the average active investor is the index. The only way to reliably capture above-average returns is to pay below-average costs. And the index fund, by definition, captures the market return at the lowest possible cost. Force 2. Market efficiency. The second force is related but distinct. Modern financial markets are extraordinarily efficient at processing information. When new information about a company becomes available in earnings report, a management change, a regulatory decision, a macroeconomic shift, that information is incorporated into the stock price within milliseconds. Not hours, not days. Milliseconds. Algorithmic trading systems, institutional analysts, quantitative models, all of them are scanning and processing every available piece of data continuously. In this environment, finding a stock that is materially mispriced, that is worth significantly more than its current market price in ways that the aggregate wisdom of thousands of professional analysts and algorithmic trading systems have all missed, is not impossible. But it is extraordinarily difficult. So difficult that, as SPIVA documents, fewer than 1 in 6 professional managers can do it consistently over 10 years. And the managers who do outperform in 1 decade rarely sustain it in the next. The index doesn't need to find mispriced securities. It owns all of them, including the ones that turn out to be mispriced in the upward direction: the Apples, the Microsofts, the Nvidias, which you would have had to identify in advance to capture their returns through stock picking. Force 3. Compounding interrupted. The third force is the most personal and the most destructive when it works against you. Compounding is the most powerful mathematical force in wealth building. It requires 2 conditions to operate at full power: time and continuity. Every interruption of the compounding process, every time you sell, every time you move to cash, every time you pay a fee, every time you realize a taxable gain, every time you trade in and out of positions, every single interruption costs you not just the current period's return, but the compound growth of that return over every remaining year of your investment horizon. Active management and speculation interrupt compounding constantly. Higher portfolio turnover means more realized gains, more taxes, more transaction costs, more periods of sitting in cash between positions. Each interruption is small. The aggregate, over decades, is enormous. The index fund is the purest possible vehicle for uninterrupted compounding. It holds. It never sells except to rebalance. It minimizes taxable events. It keeps you in the market for every day, including the days as we documented in the previous script that generate the majority of your lifetime returns. It eliminates the three forces that erode speculative returns and amplifies the single force that creates wealth: the uninterrupted, low-cost, long-duration compounding of the market's productive output. These three forces, the arithmetic of active management, market efficiency, and uninterrupted compounding, are not cyclical. They are not dependent on market conditions. They do not stop working in recessions. They do not stop working in bull markets. They operate continuously, simultaneously, and cumulatively. They are the engine that has powered $19.1 trillion into passive investing. And they are the reason that 93% of active managers, given 20 years, cannot outperform the index they are trying to beat. The SYNTHESIS, the Index Investor's Manifesto, the only framework you actually need. 7 chapters. Let me bring it all together because the synthesis of everything we've covered is not complicated. It is 4 lines, 4 commitments, and a complete, data-backed framework for building wealth through the most proven financial strategy in documented human history. Here is the complete picture. Benjamin Graham drew the line in 1949. Investing promises safety of principal and adequate return. Everything else is speculation. The S&P 500 Index Fund, over a 20-year holding period, has delivered on both promises without exception across 2 centuries of market data. SPIVA proved it for 25 consecutive years. 93% of professional fund managers, with every conceivable resource, cannot beat the index over 20 years. If they cannot do it with Bloomberg terminals and PhD teams and billions in resources, the retail speculator working alone has even lower odds. Warren Buffett proved it with his own money, 125% versus 36% over 10 years. The index won by more than 3-to-1 against the world's most sophisticated active investment strategy. The fee mathematics proved it in dollars. Over 30 years, a 0.97% annual fee difference compounds into over $417,000 in lost wealth on a $100,000 investment. The silent thief takes more than any bear market over a long enough horizon. The speculation graveyard documented the human cost. GameStop's median buyer lost 13%. Crypto's 2022 crash destroyed $1.63 trillion. The 2026 crypto crash wiped out 1.6 million traders in an hour. FOMO is not a strategy. It is a wealth transfer mechanism from the retail speculator who buys the viral peak to the early investor who was already positioned before the crowd arrived. The passive revolution confirmed the direction. $19.1 trillion in passive assets, overtaking active for the first time in history. The world's most sophisticated institutional investors have reviewed the same data you just heard, and they have been moving in one direction for a decade. And the 3 forces explain the mechanics: the arithmetic of active management, market efficiency, and uninterrupted compounding, 3 structural forces that make passive index investing not just statistically superior, but mathematically inevitable as the dominant long-term wealth-building strategy. Here is the Index Investor's Manifesto. 4 lines. 1. Own the index, not individual stocks, not actively managed funds. A broad, diversified, low-cost index fund that owns the productive output of the economy, the S&P 500, a total market fund, a globally diversified index, the product that owns the haystack. 2. Minimize costs. Ruthlessly, obsessively. Every basis point you pay in fees is a basis point the market doesn't compound for you. The math on this is unambiguous. Index fund costs are measured in hundredths of a percent. Accept nothing more. 3. Don't speculate with what you cannot afford to lose. Not meme stocks. Not speculative crypto positions. not penny stocks. Not whatever is trending on social media this week. If you want speculative exposure, treat it as a defined, limited allocation, a percentage you would not miss if it went to zero, not your wealth-building capital. 4. Hold through everything. The crash is part of the process. Volatility is the engine. The days that feel like the worst possible time to stay invested are the days that generate the majority of your long-term returns. The index investor's single greatest competitive advantage over the speculator is not intelligence, not information, not resources. It is patience. It is the decision made in advance, committed to in writing, honored in practice, to not interfere with the compounding engine while it does its work. That is the complete system. 4 lines. 2 centuries of data behind them. $19 trillion currently positioned in alignment with them. Let me leave you with the line that ties all of this together. John Bogle spent his life building the infrastructure for ordinary people to access the most reliable wealth-building engine in human financial history. And when people asked him why index investing worked so consistently, why something so boring, so unsophisticated, so devoid of the excitement that financial media sells could outperform so reliably, his answer was always the same. Costs matter. Not the market is efficient. Not stock picking doesn't work. Just costs matter. Pay less. Hold more. Own everything. Let the market do what it has done for 150 years: grow, recover, compound, and deliver its average annual return to every investor patient enough to stay in the vehicle long enough to receive it. The speculator is paying more, holding less, trading more, and receiving less. The index investor is paying almost nothing, holding everything, trading almost never, and receiving what the market delivers, which over 20 years has never been negative, and over 100 years has averaged 10.45% per year. Speculation is the game that Wall Street wants you to play, because every time you trade, they earn. Every time you pay a fee, they earn. Every time you react to a headline and make a timing decision, they earn. The house always wins in speculation, which is why the house spends so much money marketing speculation to you. The index fund is the one financial product a house doesn't want you to own because it costs them almost nothing, it pays them almost nothing, and it gives you almost everything the market has to offer. Own the haystack. Pay almost nothing. Hold for decades. Let compounding do the work. That is the entire game. And it has been hiding in plain sight since 1976. If this video gave you real, actionable clarity, hit like. It takes 2 seconds. It is the most direct way to make sure this kind of evidence-based financial education reaches the people who need it. Subscribe for more, and drop a comment right now. I want to know. Are you an index investor, a speculator, or somewhere in between? Be honest. There's no judgment here. I read every comment. Build real wealth. Be the patient investor. See you in the next one.